All right, Chris, with that as a backdrop, welcome back to the show.
Hey, it's a pleasure being back after all these years.
Yeah, I looked at the notes this morning. It said episode 122. I was like, whoa, that's aging me already here. I gotta jump on and have a good chat with Chris. So I'm glad you're back.
Yeah, same here.
So, Chris, I know they can go to episode 122 and they will, and they can get a lot of stuff there, of course, but we got a lot of updates to do. Maybe just a quick backdrop of how you landed here and what you're doing, just to bring them up to date. And then we'll just dive into whatever we think is the best.
Yeah, I mean, obviously, the bio says I'm the anti-financial advisor, right? And that's because I used to be a financial advisor back in the day. I didn't start out that way. I mean, I was trained by my parents to be, good values, right? They're good middle class, hardworking parents, teaching me to, follow my passions and my dreams, to your word is your bond, and those kind of things. But when it came to money, it was very much a scarcity conversation. It was always about there's never enough. We can't afford this. We think I am made of money. I'm not made of money, those kind of things.
Yeah.
Money doesn't grow on trees, all that kind of stuff that you might have heard of growing up too. And so when I got to be, a teenager and then an adult, I vowed I never want to be like them either. And so as I was going to college, my plan was to become a business consultant. However, I figured I better have real life business experience before just going and getting a degree. So I took a break from college. I said, all right, let's see what kind of business I could start up. I had no clue what I was going to do. And the thing that came up that became kind of intriguing was becoming a financial advisor, because I thought, worst case, I learn about money for myself. Maybe I can even help my dad get his life back, because he kept, lamenting, talking about how work was literally going to kill him because he already had strokes by the time he was in his 40s from all the
Wow.
stress. So I thought, this could be good. And I got into that. And I'll tell you, the entrepreneur bug bit me. I loved it. I stayed at it. I never went back to school. I stayed as a college dropout, never finished up. And after several years of doing that, then my dad reached out to me and says, well, when are you going to become my financial advisor? Which is surprising because this guy, he's cheap as cheap can be. Never liked anybody to know about his finances because he was very untrusting of people, right? So for him to say that, I thought, well, this is a big deal. This guy changed my diapers. Now he wants me to look at his money. Well, long story short, I sit down with him. He says, Chris, I'm 61 years old. I'm ready to quit now. What can I do? I looked at all his money. He stuffed his 401k like every good boy and good girl should. He paid off his debt, including his house, extra early. So he was totally debt free. He was like the Dave Ramsey poster child, right? And as I looked at his finances, I said, Dad, I'll be honest with you. If you want to retire today, you better hope you die in 5 years, because that's how long your money will last you before you run out. Okay, Chris, that's not what I want to hear.
Yeah, a bit of an eye opener.
Yeah, give me something else then. And I said, I don't know. You did everything right, at least according to what we teach as financial advisors. I mean, you're debt free, you've stuffed money in your 401ks, you just need to keep doing it. That was the only answer I could give them. I didn't want to put them in like some other mutual funds, because what if the market tanks? Maybe I'll be wrong. And this was 2005, so I'm kind of glad I didn't get them in more market stuff. But I didn't know what to do with them, and that bugged me. It bugged me a lot. And just a few weeks later, I'm talking with a friend who I hired to be a financial advisor, but then he quit to go to do this crazy thing called real estate investing. And I'm expecting him to be broke and thinking he wants to beg me to come back working for me again. Nope, it was the opposite. He's like super excited. He's like, Chris, man, life is awesome. We're making money left and right. My dad's doubled his income as a professor at the local university. It's amazing. I was like, dude, you've only been doing this for 5 months. No way. That's too good to be true. And it led to a conversation where he just stopped me. He said, Chris, how many of your clients are actually financially free where they don't worry about money? I said, well, none. They all worry about running out of money at some point. Great. Good job, Chris. How about this? How many of you guys are financially free as financial advisors, not off the commissions you're earning, but actually doing the investments you've been recommending? And as I looked around the office mentally, right, as I'm kind of seeing the image of about 100 people in my office, I thought, man, there's guys been working there since the late 1970s. They still can't quit. So maybe none of them can retire. So there is your problem. And that led me to, eventually taking the red pill, the matrix red pill, right? Like get to a point where I realized there was this whole other world of alternative investments and real estate investing and even hard money lending and things like that I could be doing passively to create way more income than I would with mutual funds that make lackluster returns with high risks that I have no control over. And so I finally had to make a choice. Either I stay the path I was on and keep making money as a financial advisor and just put my blinders on, or I keep my integrity intact. So I chose the latter, vowed never to teach about money again. I quit. I just became a mortgage broker in 2006 because anybody could be a mortgage broker then. And then just started learning more about this real estate stuff to the point where later that year, before I turned 29 years old, I was able to retire myself. And that blew my mind that was even possible because I was just clawing and being cheap and scrimping and saving away in mutual funds to hopefully retire by 40. And here I am doing it at age 28. And it got me to the point where I could have just sat back and did nothing, but I got bored, to be honest. And I said, okay, people keep asking me how I did it. Maybe I should do it. And so I came out of retirement to actually teach people how to do that in 2007. And that's really what I've been teaching people ever since, is how to increase their cash flow, find money, and then use that to be able to create passive income where they become work optional. They work because they want to, not because they have to.
This stuff is great for our entire community. We addressed this at one of our recent events, and hopefully we'll have you at one of the upcoming ones. Talk about, well, I wrote it down earlier. Talk about for how everyone, the whole community, I don't care if they're an investor or not, how they can get their money to pay them twice. And because that to me was like, okay, that's something worth talking about and explaining what you mean by that.
Yeah, that was a strategy I learned after I started getting into the real estate investing world, because I started talking to these real estate investors. They started talking about this thing called infinite banking, right?
Yep.
And remember, I was a financial advisor. And when they're starting talking about using the cash value, the tax-free savings account inside of whole life insurance, and I knew that that existed, but as a financial advisor, I told people, I'm like, no, don't even do that whole life crap. It doesn't pay you anything. You make way more money in the stock market. But then I hear all these real estate investors saying, oh, it's the best thing since sliced bread. And they even bought crappy whole life insurance policies, like expensive ones, the ones that I preach against today. Well, so I learned about that strategy. And of course, I remember even asking the guy that sold it to me, I said, okay, can I make this more cash rich? Because this seems like really expensive in the beginning. He said, no, if you do that, you'll get taxed. Okay, great. I'll trust you. Well, 2 years later, the recession hits. I went from millionaire to upside down millionaire because real estate values are tanking. Our new business was focused towards real estate flippers. That didn't work out so well. And so we're sinking pretty fast, and I can't keep paying my premiums. Well, the next thing I know, like, I ended up losing that policy. I paid $25,000 into it, total waste of money. I paid into this infinite banking policy, right? And I lost it. Well, months later, as I'm doing my research about it, find out the guy lied to me. I could have actually dumped more cash in and made it cheaper. And when I confronted him about it after a 2-hour debate, and even like knocking down all of his little distractions and counterpoints and things like that, it finally came down to one thing. He said, Chris, I did it because I can't afford to cut my commissions. I said, you suck, and I'm not going to resend your referral again for my friends and family and stuff. And that was it. And so over the last 15 years plus now, I've really been perfecting this strategy so that it becomes cash rich, right? So instead of losing all this money towards paying to the insurance death benefit, all this money goes into this tax-free savings account instead, where the really lion's share goes in from day one, and it builds up in there tax-free, making more than point nothing percent than you make in the bank. Yeah. But here's the cool part. Here's how you can make money twice that I didn't understand back then, because they talked about it, even the real estate investors, but they were just kind of drinking the Kool-Aid, but they really didn't know how it worked. They were talking about buying cars with it. Like, here's how you be your own bank, and, I'm going to avoid the low interest bank loan to then get a high interest life insurance loan. It didn't make sense to me numbers wise. Well, when I realized that the money that's inside this policy, right, it's growing tax-free and you can access it, but you can get a line of credit against it from the insurance company. So the money's still in there growing like 5-6% tax-free. You get this low interest loan from the insurance company to then go out and invest however you want. What ended up happening is when I started figuring out how the numbers worked, and I could do it like let's say into a real estate investment, use it as a down payment. I'm taking the cash flow, flowing that back in to pay down that line of credit. What happens is that the interest I'm paying the insurance company is less than what they're paying me. So I'm making a net profit because they're paying me more interest than I would be paying them. And I'm still making all the cash flow for my properties. And so as a result, I'm now making money in two places at the same time. And even when I started running out the numbers, I was like, man, I could actually create more passive income in the next 5 or 10 years using this strategy, combining together, than I would just doing passive investments using my savings account. And that was the big aha for me. And that's even one of the things that actually helped me to really retire again the second time around, become financially dependent in 2016 after I got myself back out of the rat race again.
So okay, so because the Wicked Smart audience, Chris, is kind of diverse, right? Who,
Yeah,
how, two questions. Who is it for? Is it for everyone? And secondly, more importantly, maybe, how easy is it to start? Like how little can they start with? Does that make sense the way I'm asking?
absolutely.
Okay.
Yeah. So it's definitely not for everyone. If you're paycheck to paycheck, you're broke, don't do it. Right. Like just buy a convertible term policy, you can convert down the road to something better like that later on. But if you're saving at least $5,000 a year, whether it's putting into savings to go do investing, whether it's into your crappy 401k, which really doesn't work even with the match because the returns are so low in those funds. If you do something like that, if you can save at least 5,000 a year, it could work for you. If you're over the age of 70, I probably wouldn't recommend this strategy as much. Also, if you're horrible health or a smoker, probably not great either. But there are ways around it. Like I had one client, he was a dentist that like 350 pounds, severely overweight, mid 50s. And he's like, listen, I know I could probably get approved, but it's going to be dang expensive. It
Yeah.
probably won't give me a very good ROI on this. I said, yeah, I agree. I'm like, are you married? Yeah, I am. How's your wife's health? Oh, she's in great health and she's 3 years younger. I said, oh, that's good because women live longer too. So that's like a triple whammy against you because you're a man, you die faster, and you're in bad health.
Well, and
She's in
side note,
good
you might
health.
want to get in shape.
Yeah, exactly. Yeah, she's in great health and younger, and women live longer. Therefore, her ROI is going to be amazing. It's going to be better. Even if you were in perfect health, she would still beat you. And so we did a policy on her where she's putting in a max, or he's putting in a max for her of about 110,000 a year. Now you asked about the minimum, right? So
Yeah.
there's always a range with the way we design it because most whole life policies, it's like this is your premium. If you don't pay it, you lose it, like it happened to me. Don't ever do it that way. Even if they're infinite bankers, most infinite bankers, sadly enough, even the ones that you see on YouTube and stuff, overcharge you on their fees by about double. And
Right.
so it's really a waste. And so when we do it, like if there's a minimum and a maximum range. So for example, let's just say the maximum you want to put in is $20,000 a year, right? Maybe you were max funding your 401k before, and you're like, okay, that sucks. Let's do something better where I can make more money in real estate. 20,000 a year might be the max. The minimum, depending on your age and health, would be somewhere in the range of maybe like $4,000 or $5,000 a year. So that's what's actually required. So you can contribute up to that 20,000 a year, but you can do less. The key thing is this: you can always pay less, but you can never pay more. So
Hmm.
whatever you set as that max, that is your max. Otherwise, it will trigger taxes, at least with the way we design it. We do it with the lowest death benefit needed to allow that money to go in. So we don't worry about death benefit. Like people say, well, how much can you get for 500,000? I don't know.
Yeah.
Let's put in the numbers and we'll find out, but usually what our clients will do is they'll say, all right, here's what I can put in per year. Here's the max, maybe the range, but here's the minimum. And we try to err on the side of them towards the maximum, something that you can actually easily do. So if somebody is putting away 20,000 a year, that's all they can do. I might recommend only doing 15,000 a year as a max with a minimum of like 3,000 a year. So it's very flexible. Oh, and here's the cool part. Worst case, if you can't even pay the minimum, if you have at least that minimum sitting in the cash account in that life insurance, you can borrow from that policy and then pay it right back in. It's almost like borrowing from your savings account and then put it back in your savings account again. So the way we design it, it's very hard to break. Like what happened to me, where I lost all that money.
Yeah.
It's virtually almost impossible to lose it using the strategy that we use.
I love it. And obviously I did a couple of those questions because I know this takes a little bit more, in-depth chat, Chris, with the people that may be interested. So let's do this before we wrap. Let's do, you have a cool program. I think it's called Wealth Accelerator. Do I have that right?
Yeah, Wealth Accelerator Academy. Yep.
I'll give them the link, and just know, guys, that it'll be a kind of a way in to chat with Chris. And if the program's for you, fantastic. If it's not, there's other avenues Chris will get with you and get custom. Go to smartrealestatecoach.com/money. That's not hard to forget, guys. Smartrealestatecoach.com/money. Chris, is there any other way they should reach out to you? Anything you want to share? And any last minute nuggets that I didn't ask so we can wrap up?
Yeah, the big thing I would just say is that in that academy, it doesn't just talk about like infinite banking. That's a small piece of it.
Mm.
Most of it's about how to find and free up cash flow, including saving on taxes, especially if you're a business owner, things like that. But also even how to invest passively and what are those opportunities out there and the different ways you can invest. So that's a big thing. It's really the education our clients will pay us 15 grand for but you get that education to do it for yourself. And it's online interactive because I actually do monthly calls with the group where you can ask questions and I can answer them. So
that's important
it kind of gives you that
deep.
access.
I appreciate you sharing that because both my son and I do a lot of this, like we just talked about, you and I, and to not have someone to kind of lean on it can be tougher. So I appreciate that. And
Absolutely.
I love that you do that for the community. All right. Awesome.
Yep.
Chris, I look forward to seeing you again. Maybe we'll get to an encore visit. We won't wait 3 or 4 years this time. And I look forward to your show. Mention your show again. I mentioned the intro, but I want them to go ahead and subscribe to that because it's a great show.
Yeah, Money Ripples podcast. You can find it on iTunes, YouTube, wherever you consume podcasts.
Money Ripples podcast. Awesome. Chris, good to see you again, buddy. Have a great week.
You too. Thanks, Chris.